So, providing and obtaining forex liquidity is a challenge, and Asia is no exception. The panel members will explain local nuances and will weigh in on the key factors that brokers, liquidity providers, and technology firms need to consider for regional growth. Victor, please.
Thanks, Michael. It would appear that liquidity of alcohol has more popularity at this time of the conference, but it is what it is. Welcome, guys, and I'm going to hand it to you to introduce yourselves.
Thanks, Victor. So my name is Kurt. I've spent my last 10 years of my career at Saxo Bank, where I look after foreign exchange, another function that I perform personally and in direct relation to that role is I sit on the FX committee on the Bank of England, and where we spent a good portion of our last couple of years drafting the FX Global Code, which, contrary to what many of you, and I see there's a lot of people out there, contrary to what you may or may not understand, as retail aggregators, we are all subject to committing to this code at some point in the near future. And perhaps we can discuss, it's not a complicated thing, but maybe some of the issues around that come up as part of our discussion today, because I think they're interesting and important for us to understand and plan for.
Nick?
My name is Nick Briscoe. I head up the Prime Services desk at Invice Global. So we are a boutique prime brokerage that services the retail brokers, asset management industry, and also their proprietary trading firms, covering FX, metals, index products, global equities, and futures.
Natalia?
Hi. Is it working? Okay. My name is Natalia Hunik. I'm a global head of sales at Advanced Markets. Advanced Markets is Australia licensed and globally based prime of prime institutional services provider. Through our tier 1 prime brokerage arrangements, we supply our clients with liquidity from top tier FX banks. We provide liquidity in spot FX, metals, and CFDs. Globally based with offices in the US, Japan, China, Cyprus, London.
Mohammed?
Hello, my name is Mohammed Rasool. I'm a director for Trade Tech Group. Trade Tech Group is a group of companies. We offer a variety of different services. We're a prime broker. We're a non-bank market maker. We're a technology provider. I've worked in the industry for 25 years, from really its inception back in the early 90s.
Christian?
Hello, I'm Cristian Blasciano. I'm the CEO of Prime XM. We are a global technology provider. We provide a range of connectivity solutions, infrastructure, bridging to retail and institutional brokers and financial institutions. Particularly, we're interested in Asia.
Hello, my name is Arthur Filipovic. I'm Senior Institutional Sales at Swissquote Bank. Swissquote Bank essentially is a Swiss bank, headquarters in Switzerland and also listed on the Swiss stock exchange. So our core businesses are really online trading, online banking, and that covers FX, CFDs, commodities, but also exchange-traded products. So we provide about 2 million products traded on exchange, ranging from stocks, bonds, options, ETFs, funds, quantitative products as well. So the bank has headquarters, as I said, in Geneva, offices in Zurich, Bern. We also have a branch in London, a branch in Malta, and also we have a banking license as well in Dubai, and an office here in Hong Kong. So I've been in this in financial industry banking for about 15 years. I'm responsible for senior institutional sales, and we cover essentially institutional clients, but also private and retail clients.
Okay, great. So let's start with a broader picture of the region and what are the differences between looking for a liquidity provider globally and in the APAC region. Kurt, want to start it?
Sure, I'm happy to start. I think on a micro level, I'm not sure there are any significant differences between liquidity supply and liquidity consumption and the science of liquidity management in Asia versus the rest of the world. I think the important aspect to be cognizant of is quite simply market impact, and there can be market impact at any hour of the day. In thin liquidity situations, the magnitude of the effect of the size and nature of one's orders or executions is of course amplified in a time zone or in a currency which may be temporarily or periodically structurally illiquid.
Right.
And that tends to happen more in Asia than the rest of the world, tends to happen more on a Sunday night, tends to, why the FX market historically opened at 7 a.m. Kiwi time, why it continues to do that at 5 a.m. Sydney, is just a historical dingleberry that we, as a global market, can't seem to get rid of. But those early hours on a Monday morning in Asia are, I would say, treacherous at best. And the fact, for example, talking about Kiwi, the fact that the RBNZ on a daily basis, not just on a Monday, has chosen to announce its rate decisions, coincident with the New York end of day, presents fragility, every time they announce.
Right. We have seen some flash crashes in the Asian hours. So this must be a big challenge for you guys to be able to execute, and probably the technological side plays a big role. Christian, what do you have to say about this?
Well, yeah, certainly it does. I think one important factor here is also connectivity, really, because because here I think what's different than in other regions in the world is the distance towards liquidity, right? So what I believe it's important is that institutions that want to tap into this market and be ready for capturing the volume that is now shifting to Asia need to have local infrastructure here, or at least use technology providers that can provide this. I think this is very, very important, and especially what Kerr said with the different hours of the day. I think it's important to be able to compose the liquidity in such a way that you can avoid such flash crashes that you have mentioned. This is an ongoing challenge to this day, actually.
Okay, so Muhammad, what do you think? Are these challenges manageable?
Yeah, most definitely. I mean, they have been for decades, right? People have been managing how to deal with illiquidity in Asia for a very long time. Like you said, why the Open has been the Wellington session for forever, I have no idea, but that's the reality, right? I think that different firms deal with it in different ways. For us, from a group perspective, we're a unique provider of liquidity, because a part of the group is really effectively a non-bank market maker. So we don't have the same types of issues that, say, an agency operation would have, because we're providing our own unique price in that time zone. So we can ensure that there's stability in our pricing. We can ensure that we provide a smooth experience on the Open, et cetera, et cetera. So I think everyone has figured out over the years, how they deal with illiquidity in Asia, because it's a big issue. Let's face it, most of the popular products that people trade are not Asia specific. Most of the things that people trade, or where the big volumes are coming out of Europe or the U.S. You look at Euro, DAX, S&P, the dollar-based crosses. So it's a tough time zone, because a lot of people that really facilitate those products and liquidity in those products are sleeping, right? So you have to be able to engineer a good experience at the end of the day for your customer. Everyone finds their way to get that done. You know, and it's a pretty mature space right now, pricing in Asia.
I think that's an important point that you raised, where you're effectively saying that, you know, the consumers of liquidity are effectively equally responsible and in control of the liquidity that they have access to, as are the suppliers. And, you know, it would be a fallacy to suggest that a number of consumers can just turn on a tap and have freely running liquidity at any time of day. So, you know, people have to be very conscious of how they consume it, when they consume it, because it has a direct effect on the ultimate supplier's ability to control that supply at the appropriate price point over the appropriate time that the tap is running.
Yeah, and I think a lot of that also depends on the demographic, like of who you're interacting with, right? Like, if you're interacting with a professional or a fund or someone who's trying to move big size in the market during that time period, that's a big issue.
And the complexity of identifying that balance and ensuring a cohesive operation of that ecosystem, which can be fragile, is critical to success and, in fact, the robustness of the overall market.
Nick, being based in the APAC region, you probably have something to add from an insider perspective?
Yeah, I totally agree with both comments. I think the market is very mature, very able to handle with all of these difficulties that are sort of perceived there in those time zones. I think the things like being able to curate your liquidity and work very closely with each of your liquidity providers that are pricing all of your clients is of paramount. Just like everything else, it's relationship driven. It's making them understand what you require out of them and the performance that you require at certain times of different times of the day. And that could be the open or the close, and the Kiwi Open is ultimately what drives the success of your business and the ability to provide that stable pricing to your clients.
Okay, so from the perspective of the composition of liquidity, we have different models, and we have STP, market making, and Natalia, what can you elaborate on related to the Asian region and the specific demands about the business model of liquidity providers? And customers, of course.
Yes, if we look at the composition of the client from Asia, I would segment them. I mean, there are larger clients who been in institutional business and they understand how liquidity works, and there are also a lot of new entrants, like new brokers, you know, who are, you know, haven't been in business and generally come from the retail space. So I would say the second segment probably would not look at liquidity and examine whether or not the liquidity provider is a TPO market maker. You know, they have their own priorities, you know, which are typically for a smaller player are around the pricing and, you know, the commission, you know, things that they care about. They're trying to be, as they are competing in the global marketplace, they are trying to be, you know, competitive and cost efficient, which it does make sense. And larger market participants, you know, funds, asset managers, they probably are looking at such criteria as fill rates and ability to execute larger clips, like larger transaction sizes, looking at what is the overall offering includes in terms of the currency pairs, exotics, crosses, of course, looking at the spreads and, you know, other characteristics.
Okay, Arthur, do you have any perspective on the business models?
Yeah, I think I agree with most panelists. It is an issue, you know, with you know, Asian pricing. If you're a liquidity provider, for example, based in Europe or North America, where you know, the liquidity consumers, you know, actually sourcing, you know, are based in Tokyo, Hong Kong, for example, etc. So, I think there are some, issues of, let's say, price latencies, transmission latencies. But, for example, I think what's important is that, in our case, what we try to do is that we have the ability to access, let's say, to provide our liquidity on multiple trading venues, So what we do is that we provide internal liquidity, our internal liquidity, and our external liquidity. Meaning external liquidity, we're connected to about 15, 20 bank LPs, exchanges, ECNs, financial institutions, and also, for example, we distribute our liquidity over PrimeXM, Integral, and other third party, which I think that's the bottom line. If a liquidity consumer based out of Asia can have access to an LP which has the ability to source liquidity internally and externally, he will have a much greater chance of being, executed the full amount for their, the broker's requested price, Of course, there are some, infrastructure limitation, but I think that's why you have, different third-party providers or other infrastructure solutions that you can access liquidity from different points, whether it's in New York, Tokyo, or London, for example. So we really try to provide our own internal and external liquidity.
So the technical tools that people like Pop and Fresh and PrimeXM supply are very useful, but as technology is an enabler. The technology in and of itself, if not used properly, can basically be fucking useless. So if one thinks that one can aggregate your prices, just your prices from Integral, from PrimeXM, from CurrentX, you haven't supplied a price in 5 million on 20 different venues simultaneously that you're willing to fill, right? The very nature of FX liquidity is indicative pricing that is subject to last look on all but 2 primary venues. And that's a very, very important factor to understand when evaluating your consumption needs and discussing how you can best access the prices that are actually available in the depth that you need, be it trading in full amount, be it sweeping across multiple providers. But, just as George Costanza got found out and called out for double dipping, so can anybody in this room quite easily. And once that happens, it can be relatively challenging to reestablish your reputation.
So, is everyone confused about what the hell we're talking about up here right now?
Friends.
Yeah.
Seinfeld.
So, it's interesting, right? We're talking about market making, STP, the LP, but are we talking about from the client's perspective? Are we talking about you're a broker, you have an LP, how does it all work, right? And it all depends on what perspective we're looking at it, because a broker who's facing a retail customer, their customers may have preconceived notions about whether or not a market maker is the boogeyman or whether or not STP is the only way to go. But the reality is all the customer cares about is whether or not they can get their trade off, right? And so what we're talking about, STP, market making, it really depends on what chink or what part of the chain we're talking about, because it means different things for different people. Like Kurt, we're talking about kind of more of an institutional, market impact, how we price, the fact that, you can't aggregate aggregators and amplify the liquidity in the market. There's only so much liquidity in the market. That's just the reality of the situation. But unless you have a huge book of business and you're trying to move big size, you're never going to run across that. If you're dealing with a retail customer who's just trying to trade, right,
Yes and no.
100,000, it's a non-issue.
Yes and no. Let's take a look at the latest Greenwich Associates market share, where they say 33% of the average daily volume in spot foreign exchange is originating from retail. Retail is now a very significant warehouse of risk and a very, very significant element in the value chain and the fabric of the overall global FX market. So it is extremely important for retail participants, not the end clients, but the facilitators, the aggregators, to recognize the importance of their role in ensuring overall functioning of that market. Because, you know, things like the Volcker rule, which has come in, which has depressed the ability, you know, of the historically of the banks to warehouse that risk. Things like Basel III, which have come in with increased capital requirements, that's increased the cost of having that risk on your balance sheet, have effectively transferred that risk to retail. And with that comes a very high degree of responsibility to ensure that, you know, whilst one client that has one trade in 500,000 is unlikely to have impact in Eurodollar in the middle of the afternoon, but when 5,000 brokers all have orders, stop orders, at a particular technical level from 10,000 clients each, that has a material ability to impact the market and can in fact be massive contribution to the cause of flash crashes, as we've seen at least 6 times in the last 2 years alone.
I don't disagree. I guess my point is, though, is that, like the Greenwich report, right? You could argue that that's not an accurate representation of the real market because so much of retail order flows never hit the street.
Yeah, so it's probably even higher.
Yeah, I would say it's much higher, right? But, and again, your points I'm not disagreeing with. I just think that for this panel, like, in the audience, it just depends on where they're at, you know, and what they're trying to engineer. Like, for us, those are, you know, material issues, right? When you're managing, you know, a book that's in the, you know, hundreds of millions or $1 billion of risk, right? But if you're a retail broker that's trying to engineer a smooth experience for a person, not even trading half a buck, but 100,000 or 10,000 or 1,000, a micro lot, right? Everyone's got their own needs, and I think that's all of us have our own way of providing or trying to provide value, right, to brokers, right?
Okay, so from a client's perspective, what should clients look for in a liquidity provider?
But so no client is going to be happy to be filled at the low of a flash crash on a stop out, right?
Just one small question to both of you, Artaz and Mohammed. How do you manage that inherent conflict between yourselves making prices to those clients as your own proprietary book versus having bank or non-bank LPs in your stack also pricing those clients and you have the direct relationship with that client?
Well, that's a good question. I mean, we try to, you know, of course we have our own book. We also have our external liquidity. It really depends on the client's profile, how he's trading. We always try to evaluate, you know, the trading style. Is it high frequency trading? We're also, you know, we're customizing the liquidity depending on different layering bands, especially on, let's say, a fixed API connection. What are their transaction sizes? Do they trade $500,000 Eurodollar, or do they trade 10 million, let's say, Eurodollar, dollar yen in one shot? You know, so it depends. Really, we do layering, we customize, you know, the liquidity. And then, of course, depending on the trade, the amount, you know, the frequency, etc., we either, you know, execute it internally, or we, you know, basically we send it out to our external liquidity. You know, that can be, you know, banks, etc. So it's really about providing, I think, fair execution. You know, of course. Another, I think, key important thing for liquidity providers is also to provide pricing during, you know, volatility events, right? Some liquidity providers stop quoting, which it makes it for, you know, difficult situation for a broker, you know, to hedge its risk. So we really try to, you know, to do the, you know, fair execution has to be about, depending on the client profile.
Do you disclose all of that to your clients? So do you disclose when you fill that trade?
If you're in a reputable regulatory regime, you have to, right? So, like, I think kind of this urban legend around the market maker being the boogeyman, like, that's relevant if you're dealing with, you know, an offshore market maker, someone from an emerging market. But, like, we're licensed and registered in the UK, right? Like, no one's, you know, and, you know, we're owned by a publicly listed company. Our balance sheet is the largest in the space. So, like, there's no funny business going on inside of our market making organization. We are hyper focused on making sure that our price is the sharpest and the fastest because we don't want to get picked off. So, I mean, if we're mispricing a broker trying to do something funky, we're going to get destroyed. You know what I mean? So it's just not even, we don't really consciously think about that conflict of interest because it's just not a part of how we can do business. And I think as long as you're dealing with a market maker or a prime broker or whatever financial institution that comes from a mature regulatory environment, that's kind of like a, you know, it's just a non-issue. You know,
Sorry, I agree with Mohammed, actually. I think we were also regulated, in Switzerland as a Swiss bank, tight controls, supervision, and I agree with him. It's all about long-term business. If your client, your broker, or whoever it is, realizes that you're mispricing them, you're slipping them out negatively, that doesn't work on a long-term basis. That the client will stop trading with you. That's
well,
pure
and the
simple.
regulators are on
too,
that.
exactly.
I mean, I remember back in, I think it was
Wait
2000.
a minute. We heard yesterday
Well,
on a
I'm
very
not commenting on
distinctive
that, right?
CEO panel that regulators have absolutely no idea about this industry.
I think that's a misnomer. I can remember
Think?
in 2009.
Sorry to interrupt, but part of the context of the question is obviously we've seen that example with FXCM and FXCM effectively running an internal book and prioritizing the flow.
Well, I don't think
it's kind
actually,
of an interesting issue for our industry at the moment.
This is maybe a I don't know, might be a little bit cheeky, but I don't actually think there was anything wrong with what FXCM was doing. What was wrong with what they were
CFTC
doing?
Asymmetric
Hold on,
last look, nothing wrong?
Let me
Okay.
finish. Let me finish. That's a different case. We're not this case.
How many
right?
cases
Yeah.
have there been?
What they were
Perhaps
doing,
that's an issue.
What they were doing that was wrong was misrepresenting to the customer what was happening, okay? But if you think about what they were doing, they were building the best price possible from their liquidity sources and then improving the price with their own internal and routing to that. So wait a second, it's bad that a customer gets an improved price? Now, there's other things that I don't agree with that Drew did over time, but that particular thing that happened with them routing order flow to a compromised entity, I don't actually think that they
And
did
telling
anything
people
wrong.
that they had absolutely no mechanism to profit from the information that was available
bad.
on their flow?
But the mechanics of what they were doing happens every day on most securities transactions throughout the world, which is brokers in the equities markets routing where they feel that they get the best price, and they price improve to route that. So that concept has been around in all mature financial markets for decades.
Not to a related entity, though.
For sure. Look
Yeah.
at Interactive Broker in Timber Hill. How many of Interactive Broker's transactions get routed to their own market-making organization, Timber Hill, as long as they enter the best bid and best offer?
Right.
More than anything that hits the street. So, I mean, again,
But
it's-
that's in a regulated
Guys.
market, right? So the
So are
the
we.
concept of
Let's.
it's still OTC. There's still not a single definitive referenceable price source. So the mechanics of the process of being very clear about the capacity in which you act, be it principal or agent in terms of the execution.
Totally agree.
Which
Totally
can be
agree.
very, very different from being principal, at the life cycle of the settlement of the trade. One can, represent themselves and facilitate market access to their clients by being agent for execution and principal for settlement.
I don't disagree. I just think some parts of that is a bit, hypocritical for the industry to pick
Yeah,
on.
it's a broad, just like it's equally broad to suggest that all principal trading is bad. It's an equal misnomer to suggest that agency-style execution, when properly disclosed and managed and handled with construction of unique liquidity sources, can in fact be very valuable to clients,
both have
whether
their
they
place.
sweep or trade in full amount. And they both have their place.
Natalia, can you tell us?
Get in on this.
Right along.
Guys, stop talking. Can you tell us about what are the procedures that you apply for to establish whether a client is suitable to be your client? What are the due diligence procedures?
Due diligence procedures. Do you really want to know about that?
Victor, this is not a fun
I
topic
don't,
here.
I
It's
don't,
not
but I
fun.
We're booked
imagine
in the
that
room
our
until
Makes
morning.
me
audience
cringe
does.
every time you pronounce the due diligence, but
I think it's very important actually for the retail broker space here in Asia. I think due diligence is very important.
So our audience, I'm sure that might be keen to know more about it.
about due diligence.
Well, about what do they need? What are the requirements for them to be clients of yours?
Right. So we are working with institutional clients only, and Advanced Markets actually has been in business since 2006. Our compliance is in the United States, and we've been NFA licensed in the past, and so that brings a lot of history. So in terms of the due diligence, it's very strict. You have to be able to, supply all the company documentation, everything about the owners, and basically drilling down as far as they can. In terms of the due diligence to do business with us, it's a little bit different from the business perspective. We obviously want to be, I want to know who is the client. I'd like to have a dialogue with the client. I'd like to understand, what type of flow they'll be sending in order to service them better. I'd like to understand what business model they are running, what technology they're using, and of course, it's important to know what currency pairs they're trading, their trading profile. And all of that is in order to, again, tailor the liquidity solution that we provide to service them better.
Nick?
First and foremost from us, they need to come from a regulatory jurisdiction and have a license that we're comfortable with. So that means FCA, SISEC, ASIC or similar. We don't accept any clients and won't entertain the thought of taking on clients that
Can you
are either
speak a
not
bit
regulated
closer to the
or
mic?
come from a jurisdiction that we're not comfortable with.
Christian, I think you wanted to say something on the matter.
Well, actually, I guess we have a different perspective as a technology provider when it comes to this, but we also do proper due diligence, especially when servicing retail brokers here in Southeast Asia. I think what we are seeing is that there are many newly established entities that are starting to run a brokerage here, and there is a certain churn, to be honest. So I think that doing proper due diligence, maybe even the best would be between all the market participants, really, is very important.
One thing on that, I think for the audience is that one of the things that we talked about to ensure, who you're going to interact with from an LP perspective, and when you're interacting with an LP that is in a mature regulatory jurisdiction, they are going to need to know pretty much everything about your company. It's always funny to me how sometimes irritated people get when you want copies of people's driver's license and passports and the bank accounts and all these things, but you want to deal with a liquidity provider that is asking you all of those things, right? Because that then means that they have an obligation, that they have oversight by other people. When we talk about market making versus STP versus aggregation and all of the conflicts of interest and all of those things, if you are dealing with someone who is in your business before you can start to do business, that should be like on your list of what you're looking for. And if you're interacting with an LP as just like, all right, let's get this done, just send me this, and we'll rubber stamp it and you're on your way through, that's a flag. You should rethink who you're doing business with, point blank. If they are not in your business, you should not be doing business with that LP because they may not be there the next day.
Most importantly, they're applying that standard to all their other clients.
Exactly.
And you're depositing collateral with them, and it's essential that your collateral is secure. So I totally agree with that.
These things are pretty black and white, Victor. I mean, like the regulators say you got to do 1, 2, 3, 4, 5, 6, right? And if you're not getting that from your LP, that's a big flag.
So maybe they're about to get a little bit even more interesting after we get wide adoption of the Global Code of Conduct Kurt, would you enlighten us
Yeah,
more
sure.
about it?
There's well, just like you're drawing, you're talking about the dependency in the network and the nodes that people have a dependency on their clients' AML and KYC procedures. So there's some natural selection in who people deal with based on the compliance procedures on both sides of where they sit in the value chain. Let's think about that as it relates to liquidity and execution. The FX Global Code has started from the central banks. The central banks are probably the largest natural producers of liquidity. The central banks have made a very clear statement that they will only transact with member banks that are committed to the global code. We're seeing accelerated commitment to this code by those institutions. We're seeing even buy-side hedge funds and prop trading firms select banks on their panel only if they're committed to the code. Since retail aggregators, ultimately, if you flash forward, since retail aggregators are also market participants as defined by the code, we will see the principles of the code expected to be adhered to by participants at our level at some point in the near future. Because just like compliance and AML procedures or discrepancies between them can have an impact today on one's market access, so too will ethics and principles and behavior begin to impact one's market access, not unlike credit and compliance procedures. I guess, the simplest, maybe a way to think about that is, if you go out to dinner with your boss, and it's Southeast Asia, it rains, very suddenly and for short duration. You walk out from dinner with your boss, you happen to be first, and it just starts pissing down rain. You need a cab home. You know your boss needs a cab home. You hit the Uber, it's a 5x surcharge. Do you hit the bid? Knowing that if you do, your boss is subject to a 10x surcharge. Or do you wait and trade in an orderly and disciplined manner when it stops raining and you both have access to the market at a fair price? Of course, one will wait. Not least because that was your annual review and you're subject to your bonus check the coming week. Now, liquidity and execution is very, very similar to that, right? So there's a principle within the code that clearly states that you're responsible for your order execution so as not to have undue market impact. So that's all of our responsibility to interact with the market in such a way.
Considering the rapidly rising trend of flash crashes, that might be a challenge. Are there any steps that liquidity providers can take to mitigate those?
Yeah, absolutely. It's like I said, not unlike just waiting a few moments for the rain to stop before you trade.
Yep.
Right? If you do that, your client is not going to get stopped out on the low of a flash crash and not be a client tomorrow. Your client will stay in his position. He will be a client tomorrow. He will pay you ongoing fees over time. Your client will be happy. You'll be happy because you have a client and because you remain viable to participate in the market in a way that is not frowned upon by participants that are larger than you, who may choose, if you don't behave in that way, to not interact with you on a forward-looking basis.
Nick?
Totally agree with all of those comments. I think most importantly, the FX Global Code is a minimum basic standard of people's behavior in the FX market. Obviously when the FX Global Code was first released, there was a little bit of conjecture within the bank or between the bank and non-bank market makers about acting inside the last look window. That has since been cleared up. The FX Global Code has been amended and is now deemed to be inconsistent with conforming to the FX Global Code if that liquidity provider is acting inside the last look window and thereafter rejecting the trade. And from our point of view, we're absolutely behind it. We think it's a great step forward in terms of the transparency of the industry, and also allowing the liquidity providers to protect themselves in markets that are moving quickly, or there is a situation where they need to provide defensive pricing, but most importantly, not acting inside that last look window. So I think, as Kurt has said, it's going to become the minimum basic standard for people acting in or providing services in our tier of the industry.
Okay, so to wrap this up, I'm going to ask you what do you guys think are the key challenges for liquidity providers to overcome in the region and to maintain this trend of growth that is kind of insulated from the regulatory impact across other jurisdictions? Arthur, can you elaborate on that?
Yeah, I think it's, again, I'm going back to my initial element, is that I think it's all about having access to liquidity on the multiple trading venues, internal, external. I think by having this kind of model, it gives you, an execution advantage. So for clients who are sourcing liquidity from Asia, they might have some latencies, but I think if you're available on several trading venues, then they can have access to your liquidity from different points.
Okay, Mohammed?
I think my biggest concern right now is not in any of the markets that have been around for a long time. My biggest concern right now is cryptos. I think cryptos is kind of like the binaries of like 4 years ago. And if we don't handle crypto liquidity well and responsibly, it's going to cause a lot of issues in the industry. I think that there is a lot of over-aggressive statements as it relates to crypto liquidity and what is possible and not possible. But if you look at liquidity in general, FX indices, equities, all of those things, I think the industry is doing we're doing what we have the obligation to do, right? I think crypto right now is outside of kind of the mature regulated markets, and it's something that everyone in the space, particularly the larger, more established firms, need to act responsibly and make sure that it doesn't cause us issues, next year, the year after, or 3 years from now, which is effectively what binaries have done to this space. So that's my biggest concern right now.
Yeah, I share that. I think that the real, true, available liquidity in cryptos, which can have a tendency, like many commodities at certain times, to be very one-way and directional in terms of the flow, makes the visible price that you think is available and you think is genuine liquidity, and when it's not there, and when you have to start going through layers of an order book which may or may not exist, there's a very extreme possibility for extraordinary price moves. If cryptos are bundled with other products like foreign exchange or bonds or equities, we're just coming out of a couple of years where we've been, as an industry, tainted with a couple of scandals. We really don't need another one that's tangentially related to our core businesses, because if that happens, it is going to affect absolutely all of us in unforeseen negative ways. That much is certain. Regulators have made it very, very clear with their actions over the last couple of years that they are not afraid to get in our kitchen, and they're increasingly entering. We don't want to give them a reason. We don't want to invite them in for no good reason.
Natalia, are you seeing more demand for crypto liquidity, and are you considering it even?
Definitely a lot of demand for crypto liquidity. I think all of us exhibiting here for the past 2 days probably, have every other person passing by the booth asking about the crypto liquidity. I would say it is a possibility where considering, but obviously it's a very early stage, and it's difficult to draw any conclusions yet. We want the market to mature a little bit before we're able to satisfy the demand. And particular concern is availability of liquidity. I mean, everyone already voiced it, so it is a possibility. How remote it is, the time will show.
Yeah, I think the balance there is just to, find ways to provide access. I mean, I'm not suggesting that cryptos as an asset class is something that should be ignored. I'm suggesting that overselling liquidity on a highly leveraged basis in an illiquid asset class is something that we should all be careful and mindful of.
This is
so much
special.
volatility.
It's a special opportunity right now with cryptos. I think it's a really special concept. I just think that the industry has to be very careful and walk through it in a very mature way, because otherwise I think we'll miss an opportunity. I think the concept of cryptocurrency is not going away, but I think very few times do you see the initial iteration of a new theoretical concept become what is adopted long-term in the space, right? And right now, we are at the early stages. Everyone just needs to be careful, know who you're interacting with. There's a big difference between the reality of crypto liquidity and what the marketing hype says. So do your due diligence.
Christian, from the perspective of a technology provider, is providing crypto liquidity any different to FX and CFDs and so on?
No, not really, except for the part that it's 24/7, really.
Yeah.
There has definitely been a huge hype regarding cryptocurrencies and a huge demand. But as everybody here has correctly pointed out, if things are not being handled in a responsible way, and to be honest, I'm not seeing that that's happening, we can end up that instead of having a stable market in cryptos that will be here to stay, we might end up having it being shut down by the regulators.
Okay, well, unfortunately we were out of time. If the audience is willing to ask any questions, they're welcome to do so after the panel to settle those. And thank you very much. And
Thank you.
enjoy the rest of the conference.
Thank you.
Thank you.
Thanks
Victor.
to all of you
Thank you.
for squeezing in, finding a seat.